Time for markets now, and Jeff Peterson, president of Heartland Farm Partners, is our analyst this week. He offered his thoughts on pricing, challenges in this market, and some ways to manage risk. Jeff also says there are different market phases that we'll need to be on the lookout for. Here's what he thinks could happen.
There are going to be different phases to this market. And the phase right now, what it's trying to sort out is it's really trying to understand where are the acres and the yield going to be, which really means all about supply. And if you think back, this kind of the price action really took off at the June report. And I think we'll look back on that and really kind of see that that was a turning point where in that report we reduced acres, we reduced yield, which meant we reduced some of our excessive stocks. And at that point the market goes, oh, this might be real. It isn't just a threat, it's real. And now it got rid of those excess stocks. Now it's trying to decide, does it need to accelerate in price faster to now start looking at rationing demand? And that's the kind of how I think this summer is going to play out. It's going to be the realization of trying to get prices high enough to make sure we have enough stocks when we get all the way out to August of 2020.
And let's talk about some of the biggest challenges that you're seeing in this market.
I think some of the biggest challenges is that we're getting a point where we're seeing more volatility in the market. Market bounces up, market comes back down, and what that does in amongst everybody is it creates emotion. And these are emotions that we haven't had a chance to feel, and some of these are price emotions above where our profitability levels are on corn more so than beans. But what that does, Troy, is it makes it really, really hard to know when to sell. And it makes it really scary because it comes back to these two fears again. The fear of missing out on a higher price, but then also if you're in an area where you had a lot of prevent plant, which isn't so much in Nebraska but in other states, you have to really deal with the fear of what if I don't produce it? And those are the emotions and challenges that we're going to have to deal with for the rest of this marketing season.
Gotcha. And Jeff, let's talk about pricing for a minute. So June WASDE shaved about 3 million off the corn acreage, looking like that's a low number. So that raised prices. What are some scenarios you see for where prices may go?
Yeah, and I think one thing we want to look at is kind of what is the current situation factoring in. If we take December futures, December 2019 futures around the 450 area, what that's pricing in is about a prevent plant number of about 4 million acres and a yield of 166. Now I think what we have to do is talk about where could those prevent plant numbers go and where could the yield go to. Well, if we wanted to take prices $1 higher, what would it need to be? So if we wanted to go from 450 to 550 on December futures, then we have to start talking about 7 million acres of prevent plant. And then we have to talk about bringing that yield from 166, bring that down to 160, and then we start talking about 550 plus.
And what are we looking at with soybeans? A whole lot going on with soybeans. What do you see?
Yeah, that's a hard one because in addition to that, we've got the situation with China. We've got African swine fever out there affecting our demand. We've got a big crop that came off out of South America. So what we're dealing with right now, as I say, unfortunately, and doesn't feel real good to say, but beans honestly are probably higher than they really should be on price. If we wanted to talk about getting the November futures price back up over $10 on the way to $10.50, then what we really have to talk about is probably 5 million acres of prevent plant, and we probably have to look at reducing the yield about 3 bushels the acre. I think both of those are possible scenarios, but that's really what we'd have to see if we wanted to move these prices up into that area.
And what advice do you have for livestock producers? Anything they can lock in right now, or do you see some animals being sold at a lower weight? What do you think?
Yeah, and that's always a tough one because when the individual who's producing grain and corn is benefiting, it's hard for the livestock side. But I think you do have to look at locking some prices in on the corn side. You have to look at either getting the bushels bought or another alternative, and I think this is a valid one too, developing some type of maximum price contract, whether through wherever you're buying those bushels for or using a call option where if the market goes higher, it still allows you to have your price locked in, but yet if prices would surprisingly drop back lower, it would allow you to pick those bushels up cheaper. But I do think you need to be locking your prices in, especially if you're looking to place something to feedlot down the road and you don't have those bushels of corn bought.
All right, we'll get out the Jeff Peterson crystal ball right now. Any projections as to where you see corn and soybean prices finally settling?
Well, I think what we have to look at is that in regard to where the highs come in, I don't think we're going to see the highs on the move that we're in right now. I think this market isn't going to be like what we saw in 2012 where the market ran straight up. I think it's going to be one more like a 1995 that ultimately carried out for some more time and really needed to better understand where the acres were at and where the yields were at. I think we've really got a legitimate shot of over $5 on corn. But that doesn't mean, and I want to put a big asterisk on this, Troy, that doesn't mean that we don't make sales. It's that I think that's possible. Over on the bean side, I think it's really a little bit too early to sell or to ultimately tell, but I think what we probably have the possibility of getting back up over $10 there too, but that one's a little bit tougher one to make a decision on.
Finally, managing risk, always important with a market like this, extremely important. What are some things that producers need to consider in that area?
Yeah, I think as we think about managing risk, the biggest thing is that it's fun to have a market that's going higher. But what we have to realize, we really have to realize that at some point we do have to make sales. And the thing that I would say is that I would be using hedge-derived contracts, so you're just setting the futures price, because I do think we'll see better basis levels down the road, and I do think we'll see that carry improve. But anytime I do make a sale in here, and I think you should have sales on here, even if you're thinking the market could go higher, you need to go ahead and add some type of call strategy to those. The reason you need to do that is to give you the ability to, one, be able to feel good about the prices going higher, but secondly, it puts a good floor price in for you. I'd rather go that way than buying puts. But if you said, you know what, I don't want to sell and buy a call, then your next best alternative would be to come in and buy puts. That would give you your downside protection. Now, there's another group of bushels that we have to think about, though, and we haven't thought about those for a while, and that's those bushels up and beyond your insured, that gap between your expected and your insured. I think we're getting to a point in here where we should consider not making sales on those. We don't want to have those sold, but we do need to consider buying puts against those, because we know at some point down the road, this market will roll over, and it will do so when we least expect it.